Hello and welcome back everyone. Thanks so much for being here today. The United States national debt has hit a new milestone and not in a good way. As of late October, the Treasury Department reported that America's gross national debt has surged past $38 trillion for the first time in history. That's about $111,000 for every single person in the country. And the speed is shocking. The debt ballooned by $1 trillion in just 82 days, less than 3 months. That kind of pace has economists, policymakers and ordinary people asking a serious question: what happens if this keeps going? I'm working on a full deep dive article for Substack and Patreon, both linked below, and I hope you'll subscribe. But let's cover the basics here first. The national debt is the total amount the US government owes to its creditors, both domestic and foreign, plus the interest on that debt. It's the cumulative result of decades of spending that's consistently outpaced revenue. In simple terms, the federal government has been using a credit card, spending more than it earns, and now the balance is impossible to ignore. The Congressional Budget Office projects that the debt will keep climbing for decades. This isn't a temporary spike, it's a structural problem baked into how our economy and politics operate today. I'd love to tell you we can cut taxes, increase spending, and everything will be fine, but we can't. Congress can play with rosy assumptions if it wants, but bond markets don't. Recently, rating agencies have turned more cautious on the US, and in response, investors demanded higher yields on the 10-year, 20-year, and 30-year Treasury notes. We're not rearranging deck chairs on the Titanic, we're shoveling coal into the boiler and setting a course for the iceberg. And this isn't just a Washington problem. The rising national debt affects you directly: your job, your wages, your loans, and the prices you pay at the grocery store. Economists watch the debt-to-GDP ratio, which compares total debt to the size of the economy. A higher ratio means the government owes more relative to what the economy produces. It's like earning $50,000 a year but owing $500,000 in loans. When debt rises faster than economic growth, the consequences ripple across everything. Higher debt means investors demand higher interest rates to lend to the government. Those higher rates spill into the broader economy. Mortgage rates rise, car loans get more expensive, credit card interest goes up, and businesses face higher borrowing costs. That can mean fewer investments, slower expansion, layoffs, and stagnant wages. Then there's the interest burden itself. The government doesn't just owe $38 trillion, it owes interest on that $38 trillion. As the balance grows, so do the interest payments. Those payments are now among the largest line items in the federal budget, rivaling defense and Medicare. That means billions that could go to infrastructure, education, or healthcare are instead used just to service yesterday's borrowing. How did we get here? Several forces converged. Mandatory spending on Social Security, Medicare, and Medicaid has climbed as America ages. Defense spending rose dramatically after 9/11 events. The 2008 financial crisis forced massive intervention to prevent collapse. And just as the recovery stabilized, the pandemic hit, triggering emergency spending from stimulus checks to business relief. Layer on the political dysfunction, debt ceiling standoffs, short-term spending patches, and failure to pass long-term budgets, and you get chronic deficits and unchecked borrowing. If this trend continues, expect higher rates on mortgages and car loans, slower wage growth as companies face tighter financial conditions, and potentially higher prices as productivity drags. The government could be forced into hard choices, including possible cuts to domestic programs that millions rely on. And while inflation is complicated, heavy borrowing raises the risk that inflation reappears in waves, eroding your paycheck and savings. If the debt keeps rising unchecked, markets may lose confidence in our fiscal management. That could trigger even higher borrowing costs, or in a worst case, a fiscal crisis. The $38 trillion milestone is a warning sign. America's financial foundation, once considered unshakable, is showing cracks. The real question isn't whether the debt will grow, it's how long it can grow before it grows out of control. Now let's turn to Texas, because the cracks are showing there too, especially in housing. Texas, the real estate giant of the South, is slowing in 2025. Median home prices statewide are down about 3.2% year over year, averaging around $331,000, more than $70,000 below the U.S. median. Austin leads the declines at 6.4%, followed by Dallas at 4.1%, San Antonio at 3.5%, and Houston at 2.8%. Inventory is up 30.7%, with more than 132,000 active listings, and homes now take about 105 days to close, significantly longer than last year. This is a sharp turn from the frenzy between 2020 and 2022. Back then, Texas's low taxes, cheap land, and corporate relocations, think Tesla and Oracle, pulled in hundreds of thousands of new residents. Listings vanished overnight and prices soared. But by 2024, supply doubled and seller dominance vanished. With mortgage rates hovering between 6.8% and 7.2%, affordability became the ceiling and demand slowed hard. The psychology flipped. In 2021, buyers feared missing out. In 2025, they fear overpaying. Bidding wars are gone. Sellers are offering concessions covering closing costs, buying down rates and adding incentives. But this isn't a crash. Texas didn't overbuild like in 2008 and population growth remains strong. What we're seeing is a recalibration, a repricing of risk. Affordability is the heart of it. A $330,000 home at 3% interest cost roughly $1,400 a month in 2021. At 7%, that same home is over $2,600 before insurance and taxes. Many middle-class buyers are priced out and sellers either cut prices or sit for months. Inventory is higher but sales are actually down 1.5% statewide. Insurance costs are piling on. Across Texas, especially Houston and the Gulf, premiums are up 20–40% as carriers absorb billion-dollar storm losses and wildfire risk. For many buyers, insurance adds $200–300 a month, erasing affordability gains from price cuts. Lenders are requiring larger escrow reserves, delaying closings that already take more than 100 days. Insurers are pulling back in flood-prone zones, and even small FEMA map updates can freeze whole neighborhoods overnight. Liquidity is drying up, fewer deals close, and the ones that do take longer. The total number of listings sits at 132,993, up 30.7% year-over-year. Homes still sell but more slowly and only after price cuts or negotiation. Realtors call it a pause market. Transactions happen but at a crawl. Sometimes the slowdown hits instantly. A Federal Reserve comment suggesting delayed rate cuts can stall deals statewide within hours. Coastal insurance moratoriums after storm warnings do the same. These micro-freezes halt activity for days, creating choppy momentum. Buyers now watch interest rate headlines like weather reports. As one realtor put it, "We're not waiting for prices to drop anymore, we're waiting for rates to breathe." Meanwhile, Texas's growth model is straining. The no-income tax appeal draws residents but limits funding for infrastructure and housing programs. Local governments face zoning backlogs, staffing shortages, and rising construction costs. Developers in Austin and Dallas report permit times have doubled. Houston is wrestling with flood regulations and inspection bottlenecks. The result is a tangle of delays that keeps the market sluggish. Texas isn't one story, it's several. Austin, hit hardest, is down 6.4% as tech layoffs and luxury overbuilding weigh on prices. Dallas-Fort Worth is mixed, some suburbs down 4%, others slightly up thanks to corporate relocations. San Antonio's prices fell about 3.5% as insurance and taxes eat into its affordability edge. Houston is relatively stable, helped by energy jobs but pressured by insurance costs. Smaller cities like Waco, Tyler, and College Station are coping with sluggish growth driven by remote workers and retirees seeking value. This uneven pattern defines 25. Texas isn't collapsing, it's redistributing. Demand is shifting outward away from overheated metros toward balanced mid-sized markets. The frenzy of 2021 has given way to a cautious equilibrium where patience and negotiation rule. Looking ahead, by late 2025, most analysts expect prices to stay flat or dip slightly, with a rebound likely in mid-2026 if mortgage rates ease. Texas's fundamentals, strong job creation, population growth, and a pro-business climate remain intact. The scoreboard: median price around $331,000, inventory up 30.7%, homes selling in 105 days, sales down just 1.5%. What does that mean for you? For buyers, this is a moment to prepare. Clean up credit, lock financing, and negotiate hard. For investors, it's a selective buying window with cash flow opportunities in stable mid-tier markets. For homeowners, remember, the market didn't crash, it normalized. As for the national debt, the takeaway is similar: discipline matters. We need sustained growth, realistic budgets, and a serious conversation about spending and revenues. Ignoring the warning signs won't make them go away. I want to hear your thoughts on the $38 trillion wall of debt and on Texas's housing reset. Drop a comment below. If you found this helpful, remember to subscribe and follow me on Substack and Patreon for deeper analysis. I'm also active on Telegram and X, and I'd love to see you there. Thanks for watching, have a great rest of your day, and I'll see you back here tomorrow. Take care.